Happy Friday, Eric Bible with the Bible team at Neil Home Loans. Another week and another round of volatility. Unfortunately, the 30-year fix kicks off this Friday at 6.68, which is up from last week's 6.62. And nonetheless, it's disheartening and discouraging. Yet, with every challenge, there's a silver lining. That said, this week I want to unpack what drove mortgage rates up, really unpack the data there, but most importantly, cover on the golden opportunity this recent run up in rates presents to not only you, but ultimately our buyers. So first and foremost, let's dive in to the news of the week. Where it was a relatively quiet week, there were three critical data points that bonds, which ultimately control mortgage interest rates, took as, hey, not the greatest news, which in turn drove yields higher, which in turn resulted in the rates we're seeing today. First and foremost, initial jobless claims, followed by Philly Fed business outlook, and close with retail sales. So we'll jump into initial jobless claims. As I've been advocating over the last few weeks, and really since the August release of July's unemployment data through the BLS jobs report, market's focus has been all over the labor force. Anything and everything related to labor is reviewed, looked at, created volatility with a magnifying glass. Each and every week, we receive initial jobless claims, individuals filing for unemployment for the first time. And we've seen a gradual hold over the last, call it 8 weeks. This week, we expected 260,000 individuals filing for unemployment for the first time, yet instead we saw 241, where, yes, not a significant miss, but nonetheless a miss, and a miss against our favor, which ultimately shows more strength in the labor market, which, again, puts challenge into the narrative that the Fed outlined in the most recent Fed cut back in September of, we want to focus on labor. We want stability within the labor market. And if we're not seeing a trove or a massive increase in initial layoffs, loss of jobs, the unemployment numbers will ultimately reflect that. So bonds did not like that. Additionally, the Philly Fed business outlook, which is a temperature check, if you want to call it, around overall output from the business economic sector. Market was anticipating a 3% lift. Instead, we saw 10.3, which ultimately is yet again more strength within the overall facets of the economy. Bonds did not like that. Additionally, retail sales. As we've been reporting over the last few months, retail sales is, again, all dollars pouring out of the consumer into the overall economy, which translates into GDP. We've seen wild variances within retail sales. Market was anticipating a 0.3% lift month over month, yet instead 0.4, which again is a small miss, but a miss in opposite to our favor, which showed consumers are still spending, albeit it's on credit, but new dollars pouring into the economy, which again is inflationary, which is a concern on the Federal Reserve's behalf. So all this combined ultimately is where and why we saw mortgage rates lift over the last week. Now, we layer in the upcoming election, and in no way, shape, or form is this going to be a political rant, so sidestep it. The election has put a tremendous amount of pressure, concern, also layering in with everything that's been evolving from a Fed monetary policy stance, overall economic outlook, what's happening abroad from a geopolitical standpoint. We layer in the election. There's massive uncertainty on Wall Street, which in turn correlates to massive uncertainty in bonds, which ultimately we're going to continue to see volatility within mortgage interest rates until, I believe, the conclusion of the election. That said, exercise your civic duty. Please vote. Don't care who you're voting for, but you can't complain unless you have a hand in the deck. So get out there and vote. With that said, what golden opportunity does this present for our buyers? Yes, interest rates are not ideal, but we have to take a step back. This time last year, mortgage interest rates were over 8%. So yeah, 6.62, it's not 3%, it's not 2%, but it's not 8. And more importantly, the component that we've all been just hammering the pavement for is inventory. We've seen a gradual increase in inventory. We have more homes available for sale than we did this time last year. Yes, it is not pre-pandemic levels, and no, it will not satisfy current demand at its core, but nonetheless, there is more available inventory for our buyers than there were this time last year. But so you may be saying, how does this address the affordability concern? How is this the golden opportunity? Eric, interest rates are higher. How does this solve our problem? Where's the golden opportunity in that? Well, additionally, we're seeing a pretty significant increase in recent price cuts, meaning homes that are listed for sale, sellers trying to chase that 2021, 2022 market, overpriced, and in turn have to come in and correct. Well, this is the golden opportunity where we know buy downs, both permanent and temporary, have always been a thing. They took a little bit of a sidestep as interest rates declined. Demand and activity picked up, as we saw with mortgage applications rising week over week. Well, now that we've seen interest rates kind of trail up, we're starting to see price drops rise. This is that opportunity for our buyers, those that can take advantage of those price cuts and parlay them into whether it be a temporary or a permanent buy down situation. There are massive tools that we have access to here at Neo that can help communicate this information. So if you have a seller that's entertaining potentially taking a price cut, the return to the client, dollar for dollar, on using that money to buying down the interest rate, whether it be permanent or temporary, as opposed to the overall price of the home, is a massive difference. You know, you want interest rates to be lower. There's an opportunity to get your interest rate 3% lower with a temporary buy down. So again, I don't want to trail off here, but the massive opportunity right now in market for our clients is the fact that we're in this kind of limbotic state. People are waiting for the election. People are waiting for interest rates to come down, more inventory to come on, the holidays, the list goes on. The individuals that take advantage of the market right this very minute are the ones that will look back a year from now and say, gosh, I'm so glad I did that. Just like the clients that did it last year, the year before that, and so on and so forth. So if you're running into challenges with conveying this message, know that we're here to support you. Reach out. We'd love the opportunity to assist. As always, let's make it a fantastic Friday and an even greater weekend. Thanks again.